Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Kevin Bales, Associate Portfolio Manager for the VictoryShares and Solutions team. The team manages assets across multiple platforms, including exchange-traded funds, passive equities, rule-based equities, multi-manager, and multi-asset solutions. Today, Kevin and I are going to discuss innovating your income for 2022. Kevin, it's great to have you with us. Welcome to Trade Talks.
Thank you for having me.
You got it. And the VictoryShares ETF platform grew to $7.5 billion in assets as we closed out 2021. What do you see as driving part of that success?
Yes. So the VictoryShares ETF platform had tremendous success in 2021. We launched 3 new ESG ETFs, including a Core Plus Bond ESG ETF, ticker UBND. And UBND is managed by the time-tested investment philosophy of the Victory franchise USA investment fixed income team. We also saw success in other parts of our platform, including our long cash suite of ETFs. And our long cash suite of ETFs are designed to allocate between stocks and cash during periods of market volatility. And our most sought after ETF in that suite was the VictoryShares US Equity Income Enhanced Volatility Weighted ETF, ticker CDC. And CDC also allocates between stocks and cash during periods of market volatility. And we saw that type of methodology do very well in 2020 during the COVID bear market, where we successfully went to cash and then reinvested at lower levels. We also saw CDC do very well in 2021 as dividend-paying stocks came back into favor. And it's also important that to note that all investments contain risk. Past performance is no guarantee of future results. But I encourage everyone to go to vcm.com/CDC for any performance holdings and prospectus information.
All right. And Kevin, you mentioned the fund outperformed in 2020. Can you provide a little more detail how it navigated the challenging market we saw then?
Sure. Yes, great question. So let me first talk about CDC's investment philosophy, and then we're going to circle back and maybe how that applied to 2020. So CDC's investment philosophy, as mentioned before, allocate between stocks and cash during periods of extended market downturns. And CDC starts with a tracking index that we use to measure CDC's drawdown from its all-time high. So we do that during monthly valuations as well, so 12 times a year. And with CDC, if we are down 8% from that all-time high, we're going to go to 75% cash and 25% stocks. And then we're going to reallocate and buy back into the market at lower levels until CDC is 32% down from that all-time high. At that point, we're going to go back into the market 100% in the equities and 0% to cash. Now, it's also important to note there's a second way that CDC can return to being fully invested once it goes to cash. And that second way is when CDC rises back above that 8% threshold, will also be fully invested 100% in stocks. So how does that apply to the 2020 COVID bear market? So CDC entered the 2020 COVID bear market 100% allocated to equities. And then once market volatility started increasing, CDC went to 75% cash on March 1st. We therefore missed the majority of that COVID drawdown during the month of March. And then on April 1st, we reinvested back into the market, going 75% equities, 25% cash, which was about a week after the market made its low. And then CDC maintained that allocation through the rest of 2020 until December 1st, when it crossed back above that 8% threshold and went back to fully invested 100% in equities. So in summary, we were very pleased with the way that CDC behaved during the COVID bear market, successfully going to cash and then successfully reinvesting at lower levels.
Right. So how do you see investors using CDC in their portfolio?
Sure. So the most common way we see CDC being used in portfolios is as a large cap value allocation, as a since it holds 100 dividend-paying stocks, we see it being used as an income generator for clients' portfolios. We also see CDC being used as an asset allocation tool, where investors can use it to de-risk part of their portfolios by going from equities to cash in a tax-efficient manner. And it's tax efficient because we do this all inside of an ETF which is a very tax efficient process to sell and then move to cash. And in fact, it's so tax efficient that CDC has never paid a capital distribution. The other way we see investors using CDC is as an equity alternative or a proxy to an equity alternative. CDC compares very favorably to long short or hedged equity type of products or ETFs. And part of the reasons why we compare so favorably to them is that CDC has only went to cash twice during its history, its inception in July of 2014.
All right, and to wrap up here, Kevin, what type of client is CDC appropriate for?
Sure. So any client that wants exposure to high dividend paying stocks is appropriate for CDC, especially ones that are uncomfortable with market volatility. Any client that has that's maybe prone to emotional decision making, which can be detrimental to success, especially during extended bear markets. And then finally, any client that wants to mitigate market risk in a tax efficient ETF.
All right, Kevin, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.